When you've been in the market long enough, you begin to realize that the real consistency doesn't come from wild rallies or dramatic collapses. No, most of the time the market drifts sideways, moving up and down without conviction. And yet, those quiet stretches are where most traders lose. Not because of volatility, but because they lose psychological control. That's what I want to talk about today. How to think and act in sideways markets like a professional. It fits perfectly after our last discussion on preparing for breakouts before they unfold, because every breakout is born within consolidation. Now let me ask you, have you ever stared at a chart that refuses to move, feeling the tension build as you wait for something, anything, to happen? That feeling is not market failure. It's a reflection of your own need for certainty and action. Sideways markets expose that need. You think the market is missing something, but really it's you who's struggling to accept uncertainty. And that's the most dangerous mindset of all, to try to force clarity from randomness. The market doesn't care about your boredom or your desire for excitement. It only mirrors your beliefs back at you. A trader must accept that sideways markets are part of the probabilistic environment of trading. They're not interruptions, they are the environment. If you can't remain balanced in them, you'll never last long enough to benefit when probabilities finally align. The professional doesn't just chase opportunity. He manages himself within uncertainty. He's a gardener of probabilities, tending to the soil of discipline. You don't pluck a fruit before it's ripe, do you? Then why enter a trade before the environment shows a clear edge? But here's the key insight. Sideways markets are not empty. They are data. The market is always expressing the collective state of belief between buyers and sellers. The public sees stagnation. The professional sees equilibrium. Which one are you? Do you view stillness as wasted time or as information about balance? That impatience to do something is how traders bleed slowly. I've seen it countless times. Small losses, one after another, all from trying to impose certainty where none exists. It's not the commissions that destroy traders. It's the erosion of belief in their own process. Sideways markets are the ultimate test of psychological discipline. They reveal whether you've truly accepted the nature of trading, uncertainty, randomness, and waiting for genuine probability shifts. Most traders can't do that. They want the market to move on their timeline. But the market doesn't operate in your personal frame of time. It has its own rhythm. If you can't align with that, you'll always fight it. So ask yourself, are you truly waiting for the presence of an edge, or are you reacting to discomfort? Patience is a trade in itself. That's something few ever internalize. Being flat doesn't mean you're out of the game. It means you're aligned with the reality that there's no edge right now. That's strength. You preserve not only your capital, but your emotional energy, your focus, your capacity to act when it matters. Some will argue that money must always be in motion. They think idle cash is wasted. That's a dangerous belief. Cash is a position of neutrality. It's the state that keeps your mind and your account flexible. In a sideways market, survival and psychological clarity are the goals. Because when the environment changes, and it always does, you'll have the resources and confidence to act decisively. Markets don't drift forever. They build energy, they coil, and then they release. Consolidation is the precondition for expansion. It's where beliefs between buyers and sellers compress before one side gains conviction. If you recall our earlier discussion on breakouts, that buildup, the quiet range, is never nothing. It's the emotional equilibrium point of the crowd. Smart money builds positions quietly. The impatient lose theirs. The professional uses these phases to observe, not to predict. He studies how conviction shows up through volume, how price reacts at the edges, how balance forms and dissolves. Each subtle shift offers feedback about changing probabilities. You don't guess, you prepare, you don't react, you anticipate from awareness. When the breakout finally comes, the professional isn't surprised. He's already mentally positioned. And that's the essence of mastery, to be psychologically prepared for opportunity before it becomes visible to everyone else. But the greatest strength in trading isn't in catching every move. It's in protecting yourself when there's no move to catch. Consistency comes from avoiding low-probability trades as much as taking high-probability ones. Many traders never realize that not trading is often their best trade. Every time you choose patience over impulse, you reinforce self-trust. Sideways markets reflect your internal state. They reveal boredom, greed, fear, and the illusion of control. Most traders can't face that reflection, so they act to escape it, and in doing so, they destroy themselves. But if you use these periods as psychological training, you grow. You develop the ability to stay neutral, to hold uncertainty without needing resolution, to act only when your edge is present. That's the mindset of a professional trader. The market's great campaigns are rare. They don't appear on your schedule. Your job is to be psychologically ready when they do. Sideways phases are not wasted time. They're the foundation of readiness. They're the silence before expansion, and only those comfortable in that silence are prepared for the next opportunity. Building wealth through trading isn't about one big win. It's about staying aligned with probabilities long enough for them to work in your favor. Blow up in consolidation, and you'll never survive to see the trend. That's the cost of impatience, sacrificing future certainty for the illusion of present control. The real difference between a professional and an amateur is most visible in a sideways market. When price moves without direction, the amateur tries to force it. He mistakes activity for control. He believes doing something equals progress. But the market doesn't reward effort. It rewards alignment with probability. The professional understands this. He treats every quiet period as a chance to deepen discipline, not test luck. He watches how belief and conviction shift among market participants. He knows the range is the arena where imbalance will eventually appear, and that's when he'll act. You believe the market owes you a trade every day, because that belief is the surest path to destruction. A professional treats his capital and his attention as finite resources. You don't waste them on noise. You conserve them for moments of clarity. The amateur, ruled by fear and urgency, exhausts both long before real opportunity arrives. And why does he do it? Impatience and fear of missing out. Two sides of the same illusion. He cannot stand stillness because it confronts his need for validation. He fears that while he waits, others are winning. But the professional knows the market is infinite. Opportunities never end, but your psychological capital can. In a sideways market, struggle equals loss. The more you resist uncertainty, the deeper you sink. The professional lets the market be. He doesn't interpret randomness as rejection. He knows that holding cash is not absence. It's readiness. That's power. The amateur sees neutrality as weakness, and that belief alone leads him into traps. Price moves between two emotional boundaries, fear and greed, resistance and support. The amateur imagines he can outsmart both. He thinks he'll time each turn perfectly. But randomness doesn't follow neat rules. The range tightens, the emotions intensify, fake-outs multiply, and he gets whipsawed into frustration. Have you ever played that game only to realize the enemy wasn't the market, it was your own mind? That's the psychological trap the professional avoids. The professional doesn't just watch the range, he uses it as a field study of behavior and belief. He observes how price rallies behave. Are they impulsive, revealing conviction, or hesitant, reflecting indecision? He notes where emotional energy shows up in volume, whether participation increases on buying waves or during declines. He studies how market participants reveal themselves through behavior, not through prediction. He looks for signs of conviction beneath the surface, whether large interests are quietly building confidence, accumulation, or quietly distributing risk, distribution. This quiet observation is what sets him apart. He doesn't act from impulse. He gathers evidence, building a mental framework until probabilities shift clearly in one direction. Then, when price finally breaks from equilibrium, he acts, not from hope, but from alignment with probability. While the amateur is mentally and financially exhausted from reacting to every meaningless fluctuation, the professional acts decisively from a calm, prepared state of mind. Think about it. The amateur spends emotional capital reacting to randomness. The professional conserves it to act only when probabilities tilt. Which mindset produces consistent growth? Which trader do you think will be ready for the rare campaigns that actually transform a career? Wealth in trading doesn't come from hundreds of small, reactive wins. It comes from a few well-timed campaigns executed with conviction and patience. Sideways markets are the psychological waiting rooms for those campaigns. Only a trader grounded in belief and self-awareness can sit in that room without succumbing to the need for excitement. Ask yourself honestly, do you want to be entertained, or do you want to be consistent? Too many traders confuse the market with a slot machine. They want stimulation, not structure. They crave the dopamine rush of action, but the market doesn't exist to fulfill emotional needs. It exists as a neutral environment. It only transfers money from those who act on emotion to those who act on discipline. Entertainment costs you emotional and financial capital. Professionalism compounds both. Sideways markets reveal exactly which side you belong to. Another common error is the illusion of control through tight stops. The amateur thinks he's managing risk, but he's actually feeding it. In a choppy environment, tight stops guarantee a stream of small losses that erode both capital and confidence. The market doesn't hunt anyone. It simply expresses the collective beliefs of those participating. The amateur exposes his own imbalance by trying to control randomness. The professional avoids this slow bleed by stepping back entirely, refusing to trade when no edge exists. He understands that restraint is not weakness, it's mastery. While amateurs fight over noise, the professional studies structure. He watches how the crowd's patience deteriorates as the range drags on. The longer prices hover without direction, the more belief and emotional capital are tested. Traders get frustrated, lose focus, and start doubting that a real move will ever happen. That's precisely when potential energy peaks. When collective belief reaches maximum doubt, imbalance follows. Then, when the breakout occurs, it feels like it came out of nowhere. But it didn't. The professional was mentally aligned the entire time. He was waiting for conviction to reveal itself, not for excitement to return. Let's connect this to your own growth. Most amateurs define wealth by activity. They think trading more equals earning more. But true wealth is built through selective precision, through filtering out noise so that when opportunity appears, you have both the financial and psychological capital to capitalize on it. The professional is never in a rush. He understands that consistency requires longevity, and longevity requires emotional and financial preservation. He knows that compounding isn't built in the chaos of sideways chop, but in the handful of high-probability moments that appear only a few times each year. If you waste your capital, mental or monetary, during periods of uncertainty, you won't have the strength or resources to seize the moments that truly matter. So ask yourself plainly, do you want to be the trader who bleeds slowly from impatience, or the one who strikes with clarity when probabilities align? The difference lies in mindset. The amateur gambles during uncertainty because he can't tolerate it. The professional endures uncertainty because he understands it's the price of clarity. That's why the amateur is always surprised and the professional is always prepared. The real challenge of trading sideways markets isn't analytical, it's psychological. It's not about predicting every minor swing inside the range. It's about mastering the inner discomfort that demands resolution. It's about training your mind to remain neutral until probability defines direction. The professional uses that neutrality to deepen his awareness. He treats the quiet as a chance to refine his process, to strengthen observation, to monitor how belief transitions between strength and weakness, to update his internal map. The amateur, driven by discomfort, fills that silence with random trades and unnecessary action. And that is precisely why one survives, while the other self-destructs. Sideways markets are not dead zones. They are psychological laboratories. They're where traders confront the truth about themselves. That single realization holds more wisdom than most will ever grasp. When you look at a chart that moves sideways, your emotional response reveals your belief structure. Do you see emptiness or do you see preparation? Most see stagnation because they're conditioned to equate progress with movement. The professional understands that potential energy builds invisibly before expression. Markets never explode without first compressing. They build conviction, absorb emotion, and digest imbalance. That coiling, that compression, is where real opportunity originates, and it always happens during those boring stretches. Have you ever wondered why major moves seem to appear out of nowhere? That's because the groundwork was laid in silence. The sideways phase is how the market organizes energy and consensus before a shift. Think of it like emotional compression. The more uncertainty accumulates, the more powerful the release when clarity finally returns. That's why consolidations, ranges, and calm markets are not obstacles, but necessary precursors to reward. The public doesn't understand this because they want excitement, not patience. The average trader abandons the range in search of motion elsewhere, right before the true move begins. The professional, however, remains present, not because he enjoys stillness, but because he accepts it as part of the process. He knows that the longer balance holds, the greater the imbalance that will follow. That patience isn't passive, it's preparation. Look at any major campaign in market history. The explosive trends didn't begin in chaos. They were born from balance. Every great move starts from a base built in silence. Without that base, the trend cannot sustain itself. So ask yourself this. When you see prices trapped in a narrow band, do you lose focus or do you lean in with curiosity? That simple answer reveals everything about your development as a trader. The impatient mind sees boredom. The professional mind sees potential energy. That difference defines results. Inside that quiet zone, important psychological and structural shifts are unfolding. Institutional participants are positioning. Accumulation and distribution are processes, not events. They unfold gradually, masked by apparent stillness. The chart looks neutral, but ownership is transferring. Volume tells this story for those who know how to interpret behavior. In accumulation, conviction builds quietly. Volume expands during strength and fades during weakness. Belief is forming. In distribution, conviction unwinds, rallies weaken, and selling pressure expands. What looks flat is actually a battlefield of expectations. So when you hear others dismiss a sideways market as dead money, smile. That's the moment professionals get interested. The so-called dead money phase is when probabilities begin shifting. It's the foundation from which clarity emerges. By the time the public notices the move, the professional has already acted. Preparation always precedes payoff. The amateur seeks excitement. The professional seeks alignment. The sideways market is alignment in disguise. If you can respect it, study it, and stay neutral through it, you'll be the one positioned for the real opportunity when it finally reveals itself. That's how real consistency is created, not by gambling within uncertainty, but by being mentally and financially prepared for the moment clarity emerges. Of course, the temptation is always there. To trade the range, to believe you can buy support and sell resistance again and again. On paper, it looks perfectly rational. In practice, sideways environments are psychological minefields. They generate false expectations, lure you into false confidence, and punish those who think they can outsmart randomness. The professional doesn't waste capital trying to control uncertainty. He conserves it. He understands that a sideways phase isn't a puzzle to be solved, but a mirror to be read. The purpose of equilibrium isn't conquest, it's information. The goal isn't to scalp noise, but to recognize when probabilities are aligning for genuine expansion. Now ask yourself, how many times have you been exhausted by indecision, only to watch a true breakout appear the moment you gave up? That's not coincidence. That's the market reflecting the emotional cycle of the crowd. Sideways phases test belief, patience, and discipline. Most fail that test. The few who remain calm, detached, and ready are the ones rewarded. Sideways markets serve another function too. They filter participants by psychology. The longer equilibrium holds, the more traders abandon belief. Frustration builds, participation fades, conviction dies. When clarity finally arrives, only those who stayed emotionally neutral remain prepared. That's why the subsequent trend is so powerful. Supply has been absorbed, resistance is gone, and demand rushes in. What looked like stagnation was actually preparation. Professionals understand this deeply. They know quiet markets are not wasted time. They are necessary time. Nothing meaningful unfolds without consolidation. Because they accept this truth, they use those periods wisely. Refining observation, rebuilding mental clarity, and strengthening conviction. When the environment finally shifts, they're not surprised, they're synchronized. So when you look at the market and see dullness, remember, dullness is simply the mask uncertainty wears before resolution. Don't mistake stillness for absence. What looks lifeless is where momentum is being born. The trader who learns to see through that disguise becomes the one positioned when others are still yawning. Protecting capital during uncertainty is as valuable as growing it during expansion. That may sound unexciting compared to chasing huge winners, but it is one of the most powerful psychological truths in trading. Most traders measure success only in realized profit. They rarely consider the invisible profits that come from not losing. Yet in the long run, survival during uncertain phases is what allows you to remain available for the phases that matter. The average trader confuses movement with progress. He thinks being in cash is failure, that his value as a trader is measured by activity. But the market doesn't reward motion. it rewards alignment. During equilibrium, there is no edge. The price represents perfect balance between buyers and sellers. Trying to force opportunity in that balance is how belief turns to frustration and accounts slowly erode. How many times have you told yourself you'll just take a small trade to stay sharp, only to find that one small trade becomes a string of small losses? That is the emotional tax of impatience, the hidden cost of refusing to wait for clarity. The market doesn't need to hit you with a major loss to destroy your progress. It can dismantle you through 100 tiny self-inflicted wounds. Protecting capital is the only antidote. And that protection is not passive. It is active discipline. It's the choice to say no to the illusion of control. It's the awareness that sometimes doing nothing is the highest form of doing something. It's learning to sit through boredom without giving in to the need for stimulation. The professional understands that his capital isn't just money, it's his psychological freedom. It's the oxygen that keeps him in the game. Without capital, there is no opportunity to apply skill. The market doesn't care about your intelligence or your opinions if you've depleted your stake before the probabilities shift. That's why the professional guards his capital during sideways stretches with the same intensity he uses to press his advantage in trends. He knows the sideways environment is where most traders self-destruct, not from market shocks, but from self-inflicted wounds of overtrading. He is conservative with his resources, patient with his emotions, and selective with his actions. Protecting capital is not avoidance, it's preparation. It requires the courage to accept boredom without creating drama. It requires the awareness to watch without reacting. Every tick tempts you to act. Every fluctuation whispers, something is happening. The professional knows that until true imbalance appears, nothing is happening. His role is to observe and preserve. Compounding in trading depends on preservation. Every dollar you protect today becomes the foundation for future growth. Lose that foundation in random noise, and you interrupt compounding before it ever begins. Think of it this way. A disciplined trader conserves ammunition like a disciplined soldier. He doesn't fire at shadows. He waits until the target is real. The trader who wastes capital in uncertainty will be empty-handed when opportunity finally arrives. Which trader do you want to be? From experience, I can tell you that some of the most important months of my career weren't those when I made the most. They were when I lost the least. Surviving without damage during indecisive markets preserved my confidence, my focus, and my capital. When the environment shifted, I was ready. Those who bled themselves during the chop were not. They were demoralized, underfunded, and emotionally broken when opportunity finally appeared. The market doesn't just reward analysis, it rewards endurance. The belief that constant activity sharpens skill is an illusion. True sharpness comes from emotional control, from observation without the need to intervene. Every reckless act you perform in equilibrium becomes a habit that will sabotage you when volatility returns. You won't become disciplined when the opportunity arrives if you've been practicing impulsiveness. Protecting capital also means protecting your psychological state. It's about preserving the belief structures that support consistent execution. The professional knows cash is not weakness, it's strategic strength. In sideways markets, cash is often the most powerful position of all. It grants flexibility, emotional stability, and readiness to strike when probabilities align. The amateur mocks cash because he equates inactivity with failure. The professional respects it because he understands restraint is the foundation of mastery. Watch how the crowd behaves when the market finally breaks out of a long range. They're surprised, wounded, hesitant. They've been chopped into frustration and disbelief. Their capital is diminished, their confidence shattered. That's the cost of failing to preserve during uncertainty. Meanwhile, the professional who waited, detached, and observed is clear-headed and funded. He can act with conviction and ride the new trend with calm confidence. Protecting your stake through quiet phases is what allows you to capitalize on explosive ones. Every lasting success in speculation rests on this simple psychological truth. Survival is victory. The sideways market is not your enemy, it is your teacher. It's where you confront your impulses, your beliefs about control, and your tolerance for uncertainty. It's the training ground of patience and the proving ground of discipline. To the untrained eye, it looks like wasted time. To the trained mind, it's the laboratory of readiness. Let me ask you directly, would you rather waste your energy reacting to randomness or wait for clarity and strike with certainty? That's the defining difference between those who chase and those who achieve. One drains himself, the other prepares. Only one builds enduring success. Patience is a position. Staying flat is a trade. Most never grasp this truth. They believe being a trader means always being exposed, long or short, as if inaction equals irrelevance. But being flat is not absence, it's awareness. Cash is not retreat, it's control. When the market is directionless, staying flat is the most professional move available. Ask yourself, how many times have you forced a trade just to silence the discomfort of waiting? You felt the itch, convinced yourself to act, even though you knew the signal wasn't there. And what followed? Small loss after small loss until the cost was no longer small. That cycle isn't about market inefficiency. It's about emotional inefficiency. The amateur confuses patience with failure. The professional knows patience is participation. He's not paid to trade every day. He's paid to wait for alignment. The market isn't a job with daily wages. It's a dynamic environment that rewards psychological readiness. You don't charge forward in every battle. You wait until the odds shift. As the saying goes, markets transfer wealth from the impatient to the patient. That isn't just a clever observation. It's the essence of trading reality. Sideways markets exist to test your ability to stay aligned with uncertainty. They'll tempt you, shake you, and pressure you to act before the time is right. The impatient will fall. The patient will survive. And in this game, survival is not just winning. It's the only way to win.